So Sundance, we're traded on the ASX. We were listed here in 2004. We also have a ADR that trades on NASDAQ. And I think I've figured out what that means is instead of having one page of legal disclaimers at the start of the presentation, we have the pleasure of having 3. So I'll just flip through those. But according to my lawyers, I'm supposed to encourage you all to read any legal statements that are at the front of these presentations. Sundance has about 55,000 net acres in the Eagle Ford, which is located in Texas in the US. We drill horizontal wells and then employ fracking technology to create pathways for oil and gas to come out of the rock and into the wellbore. So we've drilled in the past, I guess we entered the basin in 2013. We've drilled about 130 wells since we entered the basin. And with horizontal drilling, we're drilling into the actual source rock that creates the oil and gas. And so by doing that, it eliminates the majority of the geologic risk associated with a lot of conventional development. And so of the 130 wells that we've drilled, we've never had a dry hole. We had one mechanical failure where we drilled down and we hit a pocket of gas and we had to abandon the vertical portion of the well. We slid the rig over and re-drilled the well and had a successful outcome with the well. So Sundance, even though we drill oil and gas wells, we're not an explorer. We're really a manufacturing company. And so the acquisition that we made in the Eagle Ford really bolsters our ability to manufacture oil and gas by giving us good acreage where we can drill more wells to drive production, cash flow, and net asset value per share growth for our shareholders. With our drilling inventory today, we have about 13 years of manufacturing ahead of us in high return assets located again in the Eagle Ford. Our production mix is about 65% oil, just under 65%, and then about 35% natural gas and associated natural gas liquids that we sell on the Gulf Coast market. Our 1P reserve base at year end after the acquisition is just under $1 billion US in PV10 value, which really underpins, I think, the proved reserve, the proved value of the company. And our 2P value is just right around $1.4 billion in US dollars. And so that asset base, which is independently certified by Ryder Scott, I think really demonstrates the assets that the company controls that allow us to extract value for our shareholders going forward. When we closed the acquisition and with Morgan's help on the equity transaction, we provided enough capital on the balance sheet that allows us to drive our development program in the Eagle Ford without needing any new capital. And so by mid to late next year, Sundance will be free cash flow positive and still be able to grow the business within cash flow and ultimately in 2020 grow the business and generate free cash flow on top of our growth profile. As a small public E&P company, we think that puts us in a very unique position. We don't think that in the US there's very many E&P companies that generate free cash flow that are our size. And we think also with the growth profile here in the Australian market, that also puts us in a unique position. I think I heard a statistic yesterday that outside the ASX 100, the only E&P company that produces more oil and gas than us is Beach, who's producing 55,000 BOE a day and has over a $4.5 billion market cap. In September, we produced just over 15,000 BOE a day, and our market cap's about $600 million. So I think there's a lot of opportunity for the market to look at Sundance's asset base as we create value, and hopefully we can see that translate to strong shareholder returns as we execute our plan. This is just a brief history of Sundance. So Sundance was founded in 2004 with the acquisition of Cooper Basin assets, listed on the ASX to fund exploration of those assets. The founding management team at the time were two gentlemen domiciled in the US. They didn't have much success in the Cooper Basin, and so they refocused into US resource plays and put together positions in a couple of different resource plays. Our team came in 2010 at the request of a shareholder who wanted to change the direction of the business. And we put together an operating team, changed the portfolio around, and so today we're a pure play Eagle Ford growth company. As part of that, we've entered and exited 3 different basins and now entered the Eagle Ford in 2013. The first basin we entered was the Williston Basin, which was early stages in horizontal development. We acquired 3 separate assets and invested in the development of them and sold those assets to QEP, Hess, and a private company out of Denver for about $240 million US in realized proceeds on an investment of about $75 million, generating a strong rate of return for our shareholders over that hold period. We took the proceeds from those assets and invested it into the Eagle Ford, into the DJ Basin, and into Oklahoma, looking for a play today that's called Scoop Stack. In the DJ Basin in 2014, we put about $40 million into the asset. We sold it to a public company in the US called Extraction for about $115 million, again generating about a $75 million gain for our shareholders. In Oklahoma, unfortunately, we missed the target that we were looking for geologically. We ended up building a position about a mile away from a company called Alta Mesa that today has a position valued over $1 billion. So we had the same size position, and we missed it by about a mile. And so we lost $40 million looking for the Woodford, and we literally 1 mile away from having a very valuable asset. In the Eagle Ford today, now we have 55,000 acres. We're running a 35 to 40 well annual program, and that'll drive very significant cash flow, production, and net asset value per share growth for our shareholders. And we think today we have some of the best assets in the basin. So that's an introduction to Sundance. I'll step back a little bit and just briefly talk about the oil markets that we're competing in. Obviously, since I joined the company in 2010, there have been a lot of changes to oil markets. We've gone through periods of being extraordinarily undersupplied when oil's been $120 a barrel. And then we've gone through periods of oversupply, really driven by increased production out of Saudi Arabia that caused oil to go down to $26 a barrel. During that time period, Sundance got through the down cycle. About 40% of our peers in the US went bankrupt. And so it's a very different landscape today in the US, driven by those low oil prices that started in late 2014 and really got to the bottom in early 2016. Today, you can see that oil prices are starting to tick back up. Last time I looked, WTI prices are sitting between $70 and $75 a barrel, and Brent prices are about $10 a barrel higher than that. When I sat back and initially was putting the presentation together, I thought, well, why have oil prices gone up? And like most things, when a commodity market changes, it's typically driven by underlying fundamentals. And so this chart, which is from the really the Department of Energy in the US, shows what's happened with supply and demand globally to oil. And so what you can see is that in 2014 through kind of mid-2016, supply outstripped demand worldwide. And so that caused oil to go down because the market was oversupplied and the market didn't need to incentivize new production. Now that's led to some unintended consequences that we'll talk about in the next few slides. What you can see starting in 2017 is that demand, which has continued to grow and will continue to grow as long as GDP grows, is starting to outstrip supply. And the Department of Energy at least forecasts that supply and demand will come in balance sometime next year in 2019, and we should have a stabilized market. Having been investing in oil and gas assets and coal assets since 2004, I don't think I've ever seen a balanced market in the commodity space. And so I'm pretty confident that the Department of Energy is going to be wrong one way or the other. There's 3 kind of main areas fundamentally that supply oil to the market. First is OPEC. So OPEC obviously has geopolitical challenges. OPEC also today is at a point where they're at all-time lows for spare capacity. And so what that means is if an OPEC member has a political disruption like what's happened in Venezuela or with Iranian sanctions or in Libya, what's happened with ISIS, OPEC doesn't have a ton of ability to respond by significantly increasing production. They also don't have the ability to really respond to significant increases in demand for oil by pumping more oil. And that's really borne out in this chart where today they have less than 1.5 million barrels a day of spare capacity to bring online. And so what that means is that the world is effectively relying on other sources to be the swing producer. The second, I think, key area is what I would term long-dated conventional projects. And so these are projects that are typically drilled offshore or large oil sands projects in Canada, and they typically have very long lead times. And so these projects typically get sanctioned 3 to 5 years before production's expected because of the complexity and the total cost associated with bringing volumes online. And what we've seen, and I think one of the main drivers behind why oil prices have started to recover and supply-demand is more in balance, it is shown in this slide. And you can see that the green bar from 2017 to 2018, this is new production brought online from these long-dated conventional projects. We'd been ticking around at about just over 3 million barrels a day of new supply from these projects. In 2018, about 4 years after oil prices started to crash and after the industry's cut $500 billion a year in capital allocated to these projects, it's down to 2 million barrels a day, and then next year it's forecasted to drop to 1.5 million barrels a day. So in addition to OPEC being tight in terms of spare capacity, we have a situation where these long-dated projects that'll take 3 to 5 years to bring back online aren't supplying new production. And so it creates another hole in the supply chain for the oil markets today, and another reason why I think the Department of Energy forecast that will be in balance for the next handful of years might be a little bit optimistic. Lastly, and this slide's a little bit, I apologize, it's a little bit small. I stole it again from the DOE. What we're seeing in the U.S. and what we're seeing from a kind of global forecasting standpoint is the U.S. is being asked to be the swing producer for oil and gas. And U.S. shale fields have significant declines. When we bring a well online in the Eagle Ford, the well will pay out in somewhere between 9 and 18 months. But that well declines very significantly. So we might bring a well online doing 1,200 barrels a day for the first 30 days. At the end of the first year, that well is going to be doing somewhere between 150 and 300 barrels a day, depending on the production profile and the quality of that well. And what this slide shows is the 5 largest oil plays onshore in the U.S. that before the U.S. can grow production, we have to bring on over 500,000 barrels a day of new production just to offset declines within the portfolio in the U.S. That means we need more rigs, we need more people, and we need more frac crews, and then more materials and ways to transport oil out of the basins and to bring raw materials in to drive that production growth. I think historically it's been very challenging for the U.S. to be the swing producer because of this base decline rate. And while the U.S. can grow onshore production, which is at about 10.5 million barrels a day today, it'll be very hard for the U.S. to add 2 million barrels a day sustainably over the next couple of years while offsetting this decline. The secondary, I think, trend within that is that as new wells come online in that early stage of a development program, their decline rate is faster. So the first 6 months a well produces, it might decline 60% or 50%. The next 6 months, that decline slows down, so it only declines maybe 20% or 25%. But as production starts to ramp up, the total decline profile of the wells is much higher at the start, which means that as U.S. production increases, this 500,000 barrel a day decline across the U.S. is going to increase. Earlier we talked about unintended consequences of U.S. development, and this is part of why the U.S. production declines and part of why it'll be challenging for the U.S. to be the swing producer to meet demand growth. You can see the yellow line in the bottom, and what that is that's the WTI Midland Basin pricing basis. And so the Permian Basin has been the latest shale play that's attracted significant capital dollars from oil companies and investors. And you can see because we've produced so much oil out of the Permian, there's no longer a way to get it out of the basin. And so people are now, instead of using pipelines, using trucks to haul oil from Midland, Texas, which is about a 5-hour drive or more, to the Gulf Coast refining market. And those truckers are charging them $15 to $18 a barrel to move that oil. So they're getting paid at WTI minus $15 to $18, which is slowing development in the Permian Basin. We're actually seeing in the Eagle Ford, because we're located next to the Gulf Coast, we're actually seeing a premium price to WTI. So we generally receive WTI plus about $3 to $4 a barrel on our production because we're located near the Gulf Coast. And we're actually seeing frac crews and drilling rigs leave the Permian because companies can't afford to use them with a $15 basis differential and come into the Eagle Ford, which is actually driving down service costs a bit as we move into 2019 in the Eagle Ford. So between the natural declines in the U.S. and between some of these unintended consequences, the U.S. will grow production. I think the challenge is longer term, can the U.S. actually be a swing producer for the world? I think the answer is that's going to be very challenging. That introduces quite a bit of risk. And so my view is that the Department of Energy's optimistic forecast of us being in balance, in reality, we're probably going to be short oil over the next few years while some of these long-dated projects come back online or OPEC's able to build out additional capacity. So that's a brief overview on the market conditions that Sundance is playing in. And so I'll go through just briefly our strategy on how we're trying to capitalize on that. So when we acquired the assets from Pioneer in the basin, you can see that they fit the yellow blocks on there are leases that Sundance already had, and the orange blocks are blocks of acreage we acquired. So the acreage fits well with our existing acreage position, and you can see that it's surrounded by very good, high-quality operators onshore in the U.S. So the main people that offset us are Marathon, Conoco, EOG, Carrizo, and EP Energy. So those are kind of a highlight of the main guys that surround the acquired assets. The reason we had the opportunity to buy the assets is Pioneer put in place, built a midstream gathering system in 2013 to move oil and gas to market. When they did that, they attached high tariffs to the oil volumes. And so they were paying between $10 and $15 a barrel to move oil from the lease up to market. And so Pioneer sold those assets to Enterprise in early 2015 with those tariffs to get a sales price that they wanted to generate $2.5 billion in liquidity. So when we looked at the assets, they had these high tariffs, and we knew that there was, or thought that there was an opportunity to reduce pricing on those tariffs to increase the value of the assets. And so at closing, we had renegotiated those midstream contracts with Enterprise, who's the midstream company. So today we're paying, depending on the lease, $3 to $4 a barrel to move oil to market from the leases that we acquired from Pioneer. So we assumed high cost tariffs in our valuation model and think we paid a reasonable value when we bought the assets. But by renegotiating those midstream contracts, it unlocks about $150 million in fair value on the assets, which accretes directly to our shareholders and allows us to really drive the production, cash flow, and net asset value per share growth that we're focused on creating. Secondly, this slide looks at our drilling inventory. In this slide, you can see we have about 460 Tier 1 locations. The bulk of them, the biggest single block of those locations, sit in both McMullen and then in Live Oak counties. Live Oak we acquired from Pioneer, and that's where our initial development on the acquired assets has come from. And so we're drilling today about 35 to 40 wells a year, and so we have visibility to be able to drill assets and drive shareholder value and shareholder growth for the next 13 or so years through this drilling inventory across the basin. From a guidance standpoint, because of the transaction and the capital structure we put in place, we've been running a 2-rig drilling program in the U.S., and then next year we'll run probably 1.5 rigs to drill 35 to 40 wells. That creates a step change in Sundance's production and cash flow profile that I think, at least in the U.S. E&P space, today is unrivaled. So in the second quarter of this year, we produced just under 8,000 barrels of oil equivalent a day, and through deploying capital, we expect to produce 21 to 22,000 barrels of oil equivalent a day next year and generate $250 to $275 million in EBITDA off the asset base. In the third quarter, we closed on the acquisition in April of 2018, and so we put rigs to work in May, and it takes a little time to drill and complete wells. So we started bringing wells online in late August. So for the full quarter, for the full third quarter, our guidance was 10,000 to 11,000 BOE a day. We expect to be at or above the high end of that guidance range. We also announced that for the month of September, we were producing over 15,000 barrels of oil a day equivalent. So from the second quarter at about 8,000 a day, by the time we exited the third quarter, we had added about 7,000 barrels of oil equivalent a day by bringing on new wells into our production base. We have another 9 to 11 wells coming online in the fourth quarter, so our legacy production will decline. That's the nature of these shale wells, but we expect to be able to produce 14 to 15,000 BOE a day in the fourth quarter, with our December rate being higher than our September rate. So we should be able to grow the exit rate and significantly grow through the quarter. So the significance of 15,000 BOE a day is that allows us to generate, on a run rate basis, $150 to $175 million in EBITDA. And so this is really, I think, the first data point for the market to see the growth that this acquisition is providing for the company. So going from 8,000 a day to 15,000 a day in September, and now moving to 21 to 22,000 a day next year, I think we're starting to see that growth materialize, and I think that creates very significant shareholder value. From a well result standpoint, I won't spend tons of time on these. So these are the first 5 wells we brought online in Live Oak. We've had them online for over 30 days now. The dashed line at the bottom are the type curves Ryder Scott used to forecast well performance in Live Oak. The solid lines are the type curves that our internal engineers used, and then the colored lines show what the wells are actually doing. And so when we acquired the assets, Pioneer was using old-fashioned completion designs where they were pumping 500 to 700 pounds a foot of sand. Today we're pumping modern completion designs that have a very significant difference in how the frac is designed versus what Pioneer was doing. And so far we're seeing performance that's anywhere from 150 to 250% higher than type curve versus what we expected. Now we need to see, it's a little too early in these wells' lives to calculate what the total reserves will be. We need to see what happens when the wells start to bend. So in other words, when they start from that high decline period and then bend and become more parallel or more asymptotic at a lower decline rate. And so we really need to see what happens when the production profile bends to evaluate really the long-term impact. But today these wells are dramatically outperforming what we used in our valuation model. This shows, again, just the Atascosa asset, also on the acquired acreage. And you can see, again, these wells are significantly outperforming our type curve. These wells are on our legacy McMullen asset where we have more data. And so the black curve is our internal curve. Our black curves, our expectations that half of the wells will beat that type curve and half will miss that type curve. And in this case, you can see one's right on it and one's a touch below it. And so both these wells are within tolerances we'd expect on our legacy asset position. You might ask, okay, well, is Sundance the only person getting these results in the basin? We're not, although this year the acquired wells we brought online have been among the best in the Eagle Ford. One of the common metrics people look at in the US is BOE per day per 1,000 lateral feet. And in this case, our wells are averaging over 330 BOE a day per 1,000 lateral feet for the first 30 days. And that's almost twice as good as our nearest competitor. It's not that we're pumping a different frac, it's that we've acquired an asset that has significantly better geology than most of the remaining drilling inventory in the Eagle Ford. And so as we exploit it, we should be able to drive more capital efficient growth for our shareholders and more capital efficient growth than our peers in the Eagle Ford. So to sum up, Sundance has over 12 years of remaining inventory. It's high return inventory focused on tier 1 assets in the Eagle Ford. We have a significant production and cash flow ramp that's already in progress, having almost doubled it from the second quarter to our exit rate in the third quarter. And our balance sheet is structured to allow us to fully fund the development program to be free cash flow positive sometime late next year, when we should be generating north of 250 to 275 million in EBITDA, which gives us free cash flow to continue growing the business.